Hi guys, so I welcome you all to the second part of our discussion on the RBI's annual report. So in the previous video we have discussed some important aspects of that particular report, and now in this particular video we are going to move forward, cover some other very important aspects, and again you will find that these are something which you guys have already covered by now, and there will only be some value addition, and if you have forgotten some things you will be revising those particular things in this particular report. So friends, in the previous video we were discussing about the economy review and prospects, the part 1 of the RBI's annual report. Now in this particular video we are going to continue this discussion, and in the previous one we have covered this aspect, and we are there on the economic review, and we have covered till the real economy and the price situation, the inflation part. Now in this one we are going to continue with money and credit, and we are going to complete this part, and at the same time we are going to move to the second part. So let's start our discussion with money and credit. So with regard to the money and credit, this report says that monetary and credit indicators, they have rebounded from the effects of demonetization. So demonetization had some negative impact on these indicators, the money supply in the economy, but now it is rebounded during the second half of 2017-18. Money supply, which is M3. Now there are different measures of money supply: M1, M2, M3, M4. Now if we talk about the broad money, which even comprises the term deposits in commercial banks and cooperative banks, and it says that this one was driven up by the scheduled commercial banks credit growth, and this witnessed a revival from its historic low in March 2017. So this one primarily attributes to the scheduled commercial banks. So this is about the broad money major components. So you can see the growth in the past 3 years in all these components. So this is about the currency in the public, demand deposits. Time deposits are a very huge component, and then there is net bank credit, and there is this net foreign assets of the banking sector. So these are the different components of this broad money, and you can see how these components they have contributed to the growth in broad money in the overall economy. And similarly, you can look at the credit growth in the scheduled commercial banks in this particular chart. So you can see that it has also picked up in 2017-18. Now if you talk about the reserve money, now reserve money is the currency in circulation plus the bankers' deposits with RBI and the other deposits with the RBI. So this is the reserve money or the base money of the economy. And the impact of demonetization, it had negatively impacted this growth in reserve money, because this currency in circulation component, this was impacted negatively, but this reserve money component, it surged to an all-time peak of 60.6%, and this was on January 5, 2018, and it moderated to around 27% as on 31st March 2018. Now currency in circulation, which is the major driver of this particular component, it increased by around rupees 4.9 trillion. And India's currency to GDP ratio, now this one is a very important indicator. Now it says that this ratio, it moved up to 10.9% in 2017-18, and this one is among the highest levels of currency usage. So this ratio after demonetization, it has again returned to one of the highest levels among the emerging economies as well as the advanced economies in the world. Now there is also mention about this standing deposit facility in the RBI's annual report, which I believe is very important. Now the standing deposit facility, this is going to be introduced by the Reserve Bank, and there are talks about it being a better measure than the reverse repo, which is available with the RBI presently. Now the difference is that in the reverse repo, when the RBI has to absorb liquidity, it has to issue government securities in return to the banks. But in the standing deposit facility, the RBI will be privileged to suck out the liquidity without offering the government securities as collateral. So RBI need not worry about giving the government securities as collateral. It can simply suck out the liquidity from the economy, and it can measure the money supply in the economy in a easier manner. So this is something which is being talked about, and this is something which you should be aware of. Now if you move to the monetary ratio, now these ratios comprise the currency is to deposit ratio, money multiplier, and then there is also this reserve to deposit ratio. Now if you talk about the currency to deposit ratio, then this ratio, it has experienced a steep rise due to expansion in currency with the public. So currency with the public has increased, so this one has accelerated this particular ratio. If you talk about the money multiplier, now this is something which measures the credit which is available, the reserves which are available with the banks, and through these reserves the commercial banks, they generate money or credit. So this has rose to a peak of 8.8 on January 6, 2017, but it gradually declined with the process of remonetization. So during the process of demonetization, the banks were flooded with deposits. So as a result, they were having huge amounts of reserves to generate more and more money and the more and more credit. But again, after remonetization, this declined gradually. If you talk about the reserves to the deposit ratio, now this measures the reserves which the banks have to maintain. This was more or less stable because the cash reserve ratio, it was unchanged during the year. Now if you talk about the credit, the growth in the scheduled commercial banks credit, it started decelerating from November 2016. So this was the time after demonetization, and as it had negative impacts on the overall economy, so this had impact on the credit growth also. But later in November 2017, the credit growth started to pick up, and as on 31st March 2018, this growth was around 10%. And this credit growth, it was largely driven by private sector banks. So the main drivers were private sector banks and not the public sector banks. And if we look at the credit to GDP gap, so this gap, it measures the credit to GDP ratio with its long-term trend, with its normal trend. So if we compare this, it was negative. So it meant the credit in the economy, the credit demand was lower than the potential, than the long-term trend. So this was something to worry. And the non-food credit growth, it accelerated to 10.2% by March 2018 from 5.2% a year ago. Now if you look at the important trends with regard to the credit, now the growth in credit to agriculture. So if you talk about the agricultural credit, then it decelerated during 2017-18. And if you talk about the credit to industry, it turned around. There was a contraction of 1.9% in March 2017, but it was positive 0.7% in March 2018. If you talk about the credit to infrastructure, now this accounts for over 1/3 of the bank credit to the industrial sector. It contracted in a broad-based manner. So there was a decline in the different components of the infrastructure sector. And if you talk about the growth in credit to the services, this again decelerated, led by segments like trade and professional services. The personal loan segments, it recorded acceleration, and all major sectors barring agriculture, they witnessed an acceleration in June 2018. So if we take a look at the current year, that is after 31st March 2018, they started to pick up. There was an acceleration in all the credit sectors. Now let's move to the financial markets. Now if you talk about the money market, it remained broadly stable. Now with the Reserve Bank, it managed the post demonetization surplus liquidity through the reverse repo operation. So it did not allow the money market to disrupt. And if you talk about the net outstanding corporate bonds, so they increased by 14% on a year-on-year basis. And if you talk about the equity market, it was buoyed by strong rallies. So there were strong rallies in the equity market and the primary segment of the equity market. So it talks about the IPO segment. It was an important source of resource mobilization. And if you talk about the foreign exchange market, the turnover picked up and it was broadly stable during 2017-18. So this is with regard to the conditions in money market and capital market. So they were more or less stable. If you talk about the government finances, now then the provisional accounts for 2017-18, they show that the centre's gross fiscal deficit is around 3.5% of the GDP. And this is higher than what was expected in the budget. That was 3.2% of the GDP. And if we take a look at the consolidated fiscal deficit of the states in 2017-18, as per revised estimates, this is around 3.1%, and this again has exceeded the budget target of 2.7% of GDP. So both the center and the state, they have failed to meet their budgeted targets with regard to fiscal deficit. If you talk about the coming year, that is 2018-19, the center's fiscal deficit target is budgeted at 3.3% of GDP, and the fiscal deficit target of 3%. So ultimately we have to move to this 3% target, and this has been deferred to 2020-21. And the general government gross fiscal deficit, it is estimated to be around 6.6%. So if you talk about the gross fiscal deficit of the general government, it comprises both the center and the state. This is around 6.6% in 2017-18 revised estimates, and it is budgeted at 5.9% in 2018-19. So this is about the fiscal performance of the central government. So you can see about the different receipts and the different components of the expenditures of the government. And if you look at the gross fiscal deficit and as a percentage of GDP, so this was revised estimates, it was around 3.5%, and for the budget 2018-19 this is expected to be around 3.3%. Now if we talk about the path towards fiscal consolidation which the government has envisaged, now the central government has accepted the medium term fiscal deficit targets which were put forward by a review committee which was chaired by Shri N.K. Singh, but the government has adopted this with a delayed timetable. Now this FRBM review committee, it had recommended a medium term fiscal deficit to GDP ratio of 2.5% for the center by 22-23, and the committee further recommended that the combined fiscal deficit should be reduced to 5% of GDP, and this should be equally divided between center and the states. As against this, the gross fiscal deficit of 3% for the center has now been shifted to 2021, while the central government debt will be brought down to 40% of the GDP by 2024-25, and there are some other provisions with regard to escape clause and other clauses which are there in the committee, and the government has also agreed to those. So the most important point is that the government is committed to achieve these targets but with a delayed timetable. So you should remember all these targets which have been put forth by this N.K. Singh committee. External sector, if we talk about this sector, then the share of the India's exports in the world exports has been constant. So this is around 1.7%, and the India's merchandise export, the growth in this particular sector, it has accelerated, and in the net invisibles, they comprise the net earnings from export of services, remittances which we receive from the different countries, the Indians which are there in the other countries, and the net outgo of income payments which are profit, dividends and interest. This recorded a double-digit growth. So there was growth in this component. And since 2011-12, the trade deficit, the difference between the imports and the exports, it has averaged around 7.3% of the GDP. And if you talk about the overall India's external sector, it has remained more or less resilient. And the net inflow of foreign capital, it has led to significant buildup of reserves, and it has also helped us in meeting the funding requirements of current account deficit. So this is about the different important indicators with regard to external scenario. So you can see the external debt to GDP ratio is here, and this is around 20% till March 2018. And if you talk about the India's bilateral trade balance with the top 10 partners, so you can see how the India's balance is there. Top on the first one is the China, and then there is this US, and then there is UAE. And if we look at the India's current account deficit and the different components which are there in the current account deficit, so you can see this picture with regard to this. You can see that the contribution of the services and the transfers is positive, but the trade deficit and the income outgo, they are on the negative side, and overall they have kept the deficit, the current account on a deficit side. So the current account deficit is around 1.9% in 2017-18. So friends, now let us move to the working and operations of the Reserve Bank of India. So the first part we have talked about, and now let's move to the second part. And this second part, it is based on the working and operations of the Reserve Bank of India. And if you look at the annual report, this one is divided into different further sub-chapters, and these chapters are monetary policy operations of RBI, credit delivery and financial inclusion, financial markets and foreign exchange management, regulation, supervision and financial stability, public debt management, currency management, payment and settlement systems and IT, communications, international relations, research and statistics, governance, HR and organizational management, and the Reserve Bank's accounts for 2017-18. So now we are going to one by one take each of these components, and we are going to study the important points which have been brought in the annual report with respect to all these components. Now we will talk about all these components till here, and the last two components, there is not much information which is useful for examination point of view, so we have not gone into those particular components. So let's start with monetary policy operations. Now the conduct of monetary policy in 2017-18, it was guided by the objective of the medium term target, and the medium term target for CPI is, we all know, 4 plus minus 2% while supporting growth. And the monetary transmission from the policy rate to the bank's deposit and lending rates, it has improved from further during 2017-18. So the rate cuts which the RBI is making, they are gradually passing on to the customers through the banks. And in response to the cumulative 200 basis points decline in the policy rate from 2015 to 18, banks have lowered their deposit and lending rates. So gradually the monetary transmission is happening in the economy. Now another important aspect talked about in this particular chapter is about the narrowing width of the policy rate corridor. Now this policy rate corridor, it means the difference between the repo, reverse repo and the marginal standing facility rate. So this was in line with the recommendations of the Monetary Policy Framework Committee, which was chaired by Dr. Urjit Patel. And according to the recommendations of this committee, the width of the policy rate corridor has been narrowed, and this is around 50 basis points in April 2018. So the reverse repo rate is now 25 basis points below the policy repo rate, and the marginal standing facility, it is below 25 basis points. It is above the 25 basis points above the policy repo rate. So the rate corridor, it has narrowed. So this we have to remember. If we are asked about the policy rate corridor, we have to remember that this corridor has been narrowed, and this one was based on the recommendations of this committee, which was chaired by Dr. Urjit Patel. Now another important aspect talked about in the report is the introduction of MCLR system. Now this one is marginal cost of lending rate system. So this one was introduced to improve the monetary transmission. Now in order to examine the various aspects of MCLR and to suggest the refinements, an internal study group chaired by Dr. Janak Raj, it was constituted by the RBI, and its report was placed in public domain in October 2017, and its recommendations are under consideration of the RBI. So you must be aware about the basic aspects of this marginal cost of lending rate system, which we have already discussed about many a times, and also there is a separate video on this particular aspect also. Now let's move to credit delivery and monetary policy mechanism. Now Financial Inclusion and Development Department is the nodal department for implementing the Reserve Bank's financial inclusion agenda. Now this particular department, it has developed different financial literacy content, and this financial literacy content is not just one uniform content. It has been designed with regard to the needs and requirements of 5 target groups, and these are farmers, small entrepreneurs, school children, self-help groups and senior citizens. Also, financial literacy centers of the banks, they have been advised that they should structure their pedagogy for the mandated target specific financial literacy banks with the help of booklets. So the banks, the financial literacy centers which are there in the banks, they should come out with literacy camps and the booklets to improve the financial inclusion scenario in the country. Another important aspect is priority sector lending. So this particular mechanism, it was introduced so that the weaker or the vulnerable sections of the society who would have been neglected, now they should be given some amount of credit, and this was assured through making reservations for them. Now priority sector lending certificate scheme, it was also introduced in April 2016. So this was introduced to incentivize those banks who have surpassed their targets with regard to the priority sector lending. Now they can sell the extra they have achieved through these priority lending certificates. Now RBI has provided the banks with the platform to trade these certificates, and this is through its core banking solution portal, which is eKuber portal. I believe this you must be aware of. And this platform, it saw active participation from all the eligible entities, including urban cooperative banks and small finance banks. So all the entities, they participated in the priority sector lending certificates trading. Now with regard to the review of the priority sector lending targets, the report says that now the foreign banks with 20 and above branches, they also have to comply with the sub targets with regard to the priority sector lending for small and marginal farmers, which is around 8%, and for lending to micro enterprises, which is around 7.5%. So they were given a 5-year roadmap, and now this roadmap is effective from 2018. This roadmap has now ended, and they have been kept on par with the domestic banks from 2018-19. Also, it has been decided to remove the loan limits for lending to micro, small and medium enterprises for classification under the priority sector, and also the housing loan limits for eligibility under the priority sector loans, they have also been aligned with the Pradhan Mantri Awas Yojana. So these all components, they again have been separately discussed by us in one of the videos. So I believe you must be aware about all these by now. Now if you talk about the agriculture credit, now the government, it fixes the target for agriculture credit every year. For 2017, this target was rupees 10,000 billion, and as on March 31st 2018, the commercial banks have achieved their 124.6% of their target. However, the cooperative banks, they have achieved only 96% of their target, and regional rural banks only they have achieved 100.7%. Now for 2018-19, the target is rupees 11,000 billion. So this is a very important figure which you should remember. Now the report also talks about the progress made in the Kisan Credit Card Scheme, which is being implemented by scheduled commercial banks, RRBs and cooperative banks, and they are effectively working for providing both short-term and long-term loans to farmers. So this is about the growth achieved in the Kisan Credit Card Scheme. Now the report also talks about another scheme, which is Certified Credit Counselors Scheme. Now this is in accordance with the first bi-monthly monetary policy statement for 2016-17, in which the framework for accreditation for credit counselors, it was prepared by RBI and it was provided to SIDB, and subsequently it launched the Certified Credit Counselors Scheme in July 2017. So the SIDB, it acts as the registering authorities for these certified credit counselors. Now what do these counselors do? They are expected to advise the MSMEs in preparing their business proposals and financial documents statements for obtaining due credit from the different avenues which are available for them. Now further, the report talks about the revamping of the lead bank scheme. Now under the lead bank scheme, one bank in each district is assigned the leadership role, and it coordinates the effort of all the banks in that particular district. Now as a part of this lead bank scheme, the state level bankers committees, they are constituted, which are the highest banking committees at the state level, which coordinate and direct the banking activities at the state level, and some changes have been made with regard to this committee. And as of June 2018, 20 public sector banks and 1 private sector bank, they have been assigned the lead bank responsibility. Further, the small finance banks, they are also participating in this scheme, and they are also coordinating at the relevant fora which is available for them. Now then it talks about the Committee on Medium Term Path on Financial Inclusion. So this is important. We have to remember that this committee, it was chaired by Shri Deepak Mohanty, Executive Director RBI, in 2015. Now major recommendations which were put forth and they were implemented during 2017, they include a business correspondent, a banking correspondent registry portal, and a basic certification course for banking correspondents have also been commenced, and a CCC scheme which we have just discussed, it has also been announced. Now with regard to the other measures of financial inclusion which have been taken up by the RBI, the guidelines on branch authorization policy, they mandate that the banks should open at least 25% of their banking outlets during a financial year in unbanked rural centers, so that they are also able to access the banking services. Also, the National Strategy for Financial Inclusion document, it is being finalized under the aegis of Financial Inclusion Advisory Committee, and this is going to put forth the RBI's inclusion policies. And the banks have also been advised to prepare board approved financial inclusion plans, so that the financial inclusion could be promoted by the different banks. Now let's move to the initiatives for financial literacy. Now block level Center for Financial Literacy project, it was initiated in 2017 by RBI in 7 states, and this project is currently being implemented by 6 NGOs in collaboration with 10 sponsor banks. So this is a very important project with regard to promoting financial literacy in the country. Also, the National Center for Financial Inclusion, it comes out with different videos, different messages to generate awareness. And further, the Reserve Bank in collaboration with OECD has also organized the RBI OECD High Level Symposium on Financial Inclusion, and this was held in November 2017 in New Delhi. So this is about the initiatives for financial literacy. Now another important initiative is Financial Literacy Week 2018. Now, in order to create a large scale awareness on different key topics, Reserve Bank has decided to observe 1 week every year as a Financial Literacy Week starting from 2017. Now, in 2018, this week it was observed from June 4 to 8, 2018, and the theme was consumer protection, and it focused on 4 consumer protection messages. First one was know your liability for unauthorized banking transactions, banking ombudsman, good practices for a safe digital banking experience, and a risk versus return. So we have to remember these aspects about the Financial Literacy Week 2018. Now let's move to financial markets and foreign exchange management. Now there is this department in the Reserve Bank, which is the Financial Markets Regulation Department, and it is tasked with the responsibility for development, regulation and surveillance of money, government securities, foreign exchange and the derivatives market. So this is primarily the department concerned with this particular aspect of economy. And the department, it has taken a number of measures during 2017-18 to broaden the participation in financial markets, so that more and more participants, they come and enter the financial markets and access the different kinds of financing which is available in the market. Now if you talk about the measures introduced, then there were different measures which were introduced in the previous financial year, and these include the shifting of limits for foreign portfolio investors, introduction of interest rate futures and interest rate options, and they have been all discussed by us one point or the other time in the different RBI notifications videos which are brought for you guys. And if you have not covered these videos, now I don't believe it's the right time to go deep into these particular aspects, because they are a bit technical and complicated. Now if you talk about the FPI investment limits and the regulatory regime for the FPI's debt investments, it was reviewed, and the limit for FPI investment in debts, it has been linked to their outstanding stock. So the limit for FPI investment in debt, it is kept at 5.5% of the central government securities, and 2% for the state development loans, and 9% for the corporate bonds for 2018-19. So we have to remember that FPI's, foreign portfolio investors, debt investments, they were reviewed and they have been linked to the outstanding stock, outstanding debt. Investment in corporate bonds, they have also been rationalized, and the different limits which were there in different subcategories, they have now been discontinued, and a single limit has been prescribed for all types of corporate bonds. Now let's move to the next department, which is the Financial Markets Operation Department. So it is entrusted with the responsibility of conducting liquidity management operations in the economy. Further, it is also concerned with ensuring that there is orderly development and orderly conditions which are maintained in the forex markets, and this is done through the operations in spot market, forward market and futures segments. Now further, there were talks about new tools to absorb liquidity in the economy, and in these we have a securities borrowing and a lending arrangement scheme. So this scheme, it was put in place under which the RBI, it can borrow securities from large institutions to conduct reverse repo operations. Also, the standing deposit facility has also been made available for adoption. So this we have already discussed, and we have to remember that there is this particular another arrangement which is there, by which RBI can borrow the securities and conduct the reverse repo operations. Now if you talk about the foreign exchange market, then this new foreign exchange global code has been formulated by the Bank for International Settlements, and this has strengthened the standards and practices in the global foreign exchange market. And this code, it was launched on May 25, 2017, and it is being implemented globally by the Global Foreign Exchange Committee. The Reserve Bank is also a founding member of this particular committee, and in India, this local financial foreign exchange committee, it is being set up, and it is coordinating with the Foreign Exchange Dealers Association of India to take forward the implementation of this particular code. So we have to remember that this particular code has been formulated by BIS with regard to the foreign exchange market, and in India also this is being implemented, and the Reserve Bank is also a founding member of this particular committee. Now there is this also a foreign exchange department which strives to facilitate trade and payments in the foreign exchange, and it is bringing out new technologies, streamlining the regulations which are there to ease this particular process with regard to foreign trades and payments. Now the foreign exchange measures which were taken, and these include FTI and FPI limits. They have been defined in line with the recommendations of this very important committee, which is Dr. Arvind Mayaram committee. So this is in news, and this keeps in news. This is a bit old committee, but since it is often in news, you need to remember this one. And further, the regulations have also been introduced for cross-border merger proposals, which we have again discussed in a separate video. So I believe you must be aware about this. This is very simple. This means that one entity is from India and other one is from another country, and they have to merge their operations. How they can easily do so, and the regulations with regard to the FAMA and the company law, they are being rationalized in this regard. Further, the status of NRI and OCI, which is overseas citizen of India, it is also being redefined with regard to the transactions in immovable property. Further, the rupee denominated bonds which are issued by overseas, which are issued overseas by Indian entities, they are excluded from the FPI investment limit in corporate bonds. So there is this limit, and by excluding these, we have slightly increased the limit. Further, the practice of issuing LOUs and LOCs, so letter of undertakings and a letter of credits for trade credits for imports into India by authorized dealer category 1 banks has also been discontinued from March 13, 2018, and this was particularly in the light of the PNB fraud. So friends, this was all about our discussion on the second part of RBI's annual report. Thank you.